This video series could be completely change the way you look at audit, accounting, tax, receivables, payables, investment analytics, and lot more. And honestly, these are the core concepts you need if you want to build a strong career in finance and accounting. Now, hello everyone, welcome to this Pro the Journey YouTube channel. I'm Mr. Rai. I help you study professional knowledge in a simple and a practical way. So let's start. In this series, we are going to cover important topics like sales and purchase, including tax, inventory, tangible and non-current assets, intangible assets, accrual and prepayments, receivables and payables, and much more. And we will understand all of these step by step using the double entry accounting system. But before we begin, make sure you have already watched my video on double entry and bookkeeping. If not, go check it out first. The link is in I button. So now, let's start with the sales and purchase, including trade discounts, settlement discounts, and tax implications. Here's the thing, sales and purchase can happen in a two-way, either in cash or in credit, which simply means delay in payment. Now suppose if sales happens on credit, the journal entry for the credit sales will be receivables account debit $500 to sales account credit $500. And for credit purchases, purchase account debit $500 to payables account credit $500. So basically, receivables are assets, sales are income, and on the other side, purchases are expenses, payables are liabilities. Now, because receivables and payables involve future payments and collections, they are also treated as financial instruments, where we will go in professional level. Now let's see what happens if the transaction is in cash instead of credit. For cash sales, cash and bank account debit $500 to sales account credit $500. And for cash purchase account debit $500 to cash and bank account credit $500. Since payment happens immediately in cash, there are no receivables and no payables remaining afterward. Now what if goods are returned? Let's start with the sales return on credit. The entry would be sales return account debit $200 to receivables account credit $200. Then sales account debit $200 to sales return account credit $200. Now, sometimes businesses pass a simple net entry directly, like sales account debit $200 to receivables account credit $200. And if it's a cash sale return, the journal will be like sales account debit $200 to cash account credit $200. Similarly, if purchase returns, the journal will be like payables account debit $200 to purchase return account credit $200. And for cash purchase return, cash account debit $200 To purchase return account credit $200. So basically, we are simply reversing the original transaction in proper accounting way. Now let's move to the taxes on sale and purchase. And don't worry too much about tax rates. Different country uses different name like GST or VAT, and rates also vary from country to country. In exams, rates are usually given. So your job is not to memorize rates. Your job is to understand how tax works in accounting. Now remember this. Gross sales is equal to net sales plus tax. For example, suppose the actual sales value is $100 and the tax is 10%, which is $10. Then the customer finally pays $110. So $100 is the business income, $10 is the tax collection. Same logic applies to the purchases. Gross purchases is equal to net purchases plus tax. Net purchase become expenses and the tax part is recorded as separately. Now businesses later calculate tax collected on sales minus tax paid on purchases, and depending on the difference they either pay tax to the authority or receive a tax credit. Now here's a very important point. Tax collection on the sales is not income. It's actually a liability because the business has to pay it to the tax authority. And tax paid on purchases is not expenses. It's treated as an asset because the business may recover it later as a tax credit. Now let's see the journal entries. Suppose we have credit sales with tax. So the journal will be like receivables account debit $550 to sales account credit $500 to sales tax account credit $50. So here receivables are assets, sales are income, and sales tax is a liability. Now for purchases. Purchases account debit $500, purchases tax account debit $50 to payables account credit $550. Here, purchase is expense, purchase tax is an asset, and payables are liabilities. Now let's see the same thing with the cash transaction. For cash sales, cash and bank account debit $550 to sales account credit $500 to sales tax account credit $50. And for cash purchases, purchase account debit $500, purchase tax account debit $50 to cash and bank account credit $550. Now after taxes, let's understand discounts. There are mainly two types: trade discounts and settlement discounts. Trade discount is given at the time of sales, usually to the encourage bulk purchases. Settlement discount is offered after the sales, mainly to encourage earlier payments. Now trade discounts are simple. The discount is reduced before recording the sales, so the only net amount is treated as the actual sales revenue. For example, Mr. Rai sells good worth of $500, trade discount is 10% and sales tax is also 10%. So the entry becomes receivables account debit $495 to sales account credit $450 to sales tax account credit $45. And when payment is received, cash at bank debit $495 to receivable account credit $495. Simple. Now let's talk about settlement discounts. This depends on one important question. Is the customer expected to pay earlier and claim the discount or not? Let's understand this with example. Suppose Mr. Rai sells good worth $500, sales tax is 10% and the customer gets a 5% settlement discount. If payment is made within 10 days, now if the customer is not expected to pay early, then full sales amount are recognized. So the entry is receivables account debit $550 to sales account credit $500 to sales tax account credit $50. But if the customer is expected to take the discount, then the sales are recorded at the expected reduced amount. So the journal will be receivables account debit $522.5 to sales account credit $475 to sales account credit $47.5, because $500 into 95% is equal to $475 and tax 10% is calculated on reduced amount, which is $475 into 10% is 47.5. Now suppose the business expected the customer to take discount, but the customer did not take it. Then extra revenue is recognized later. So the entry will be like cash at bank debit $550 to receivables account credit $522.5 to sales account credit $25 to sales tax account credit $2.5. So this additional amount becomes extra sales and extra tax liability. Now the opposite situation. Suppose the business did not expect the customer to take the discount, but the customer actually take it. Then the entry becomes cash at bank debit $522.5, sales discount account debit $25, sales tax account debit $2.5, to receivables account credit $550. So here, sales discount is treated as an expense or reduction in revenue, and tax is reversed proportionately. Now similarly for purchases. If the purchaser takes the discount initially, so the journal will be like purchase account debit $475, purchase tax account debit $47.5 to payable account credit $522.5. And if initially discount was not expected but later received, then the journal will be like purchase account debit $500, purchase tax account debit $50 to payables account credit $550. Later, payables account debit $550 to tax reversal account credit $2.5 to discount receive amount credit $25 to cash at bank credit $522.5. So here payables are settled. Tax is reversed, discount received becomes income, and cash is paid. Now we have covered this topic in a lot of detail. But still, I did recommend practicing more questions from the reference books. And if you have any doubt at all, just drop them in a comment below. You can also explore the ACCA practice platform. And if you want a separate video explaining how to use the practice platform, comment below and I'll make one for you. Our goal here is simple: no unnecessary theory, no boring PPT style teaching just to increase watch time. We want to make accounting concepts simple, practical, and actually interesting. And if you want more practice video, let me know in the comment and I will see you in the next video. Till then, keep practicing, keep going.